Let's ask John Mowrey, Chief Investment Officer from NFJ Group. He's here with me at Post Night. It's good to see you again. Welcome back.
Thanks, Scott, for having me back.
A lot of people are still bearish. Are you as bullish as you've been when you've sat in that seat?
Well, I first want to comment on a statement you made that people should maybe take profits. I think the problem is people haven't been invested. So, last quarter, you saw $500 billion flow into money markets and cash. That's the largest number since March of 20. So people are very overweight cash. When we meet with our clients, meet with investors, a lot of people are saying we're overweight bonds, we're overweight cash, we're overweight staples. So I think that people have not been positioned for it, and it's kind of been a nosebleed rally as it's moved higher.
Because they don't believe in it. They think it's just yet another bear market bounce, and the real tell is what's going to happen next. And you may go back, they say, to test the lows. I mean, even some of the most bullish that we speak to, like Brian Belsky, not that he's turned into a bear, but he says, quote, that last night in a note, for the first time in many years, our enthusiasm for stock market performance potential this year is relatively tempered. I mean, that's Belsky. He's as bullish as they've come. You are too.
Well, I would say two things. So we've had two big quarters in a row, the fourth quarter and then the first quarter. I mean, those are like, 7% plus quarters in a row. So that is significant. What I would say is from a portfolio manager perspective, it's hard to always talk about the macro, even though it's filled with riddles. But on a bottom-up basis, I do think that some of the semiconductor stocks have gotten less attractive. Home builders have gotten less attractive. Some of the machinery stocks have gotten less attractive. But what is attractive, Scott, application software, life science, REITs, and I know you're going to bring up financials at some point, and yes, financials do look interesting here. So I think there are opportunities for investors, and I think that just because it's snowing and you may have to put on your goggles doesn't mean you shouldn't go down the ski mountain.
No, but are you still going to slip on the ice if you try and get into the market thinking that, everything's going to be just fine?
Not if you're not overpaying. So what occurred in October was that people basically dumped everything. They sold all the stocks. They did not look at valuation. They were fearful that rates would just continue to grind higher. They were also fearful that we were going to move into a massive recession. Both those things have not occurred, and it created that dislocation. We're having the same thing happen now in real estate, in banks, and in some of the other areas I mentioned.
We don't know what's to come in real estate, commercial real estate, and frankly, we don't really know what's yet to come for the banks either.
We don't, but a couple things that I would say about that. The first is that, yes, are there some boiling frogs out there in the real estate market? Probably. There probably are some. But that doesn't mean you don't want to have any exposure. I mean, for example, the S&P 500 banks are roughly 5% of the S&P. So if you say I don't want to own banks, I don't want to own REITs, then just throw out the S&P. Get rid of your allocation. So I think that you have to address those industries and sectors. And for example, Scott, regional banks now have a 200 basis point premium to the 10-year with dividend growth versus no growth on the 10-year. So I do think there are compelling opportunities. And
in regional banks.
In regional banks. The super regionals in particular, I think, are an interesting place to look at because they could be beneficiaries of what's going on with the smaller banks where you're seeing deposits flow away from those.
The whole conversation, I think, hinges on whether you think the greater investment community thinks that things are going to get worse from here, or if we're in the process of troughing, whether it's from earnings or the economy. Chris Harvey, Wells Fargo, says sell before May and go away. And he was looking for a rally, but he's also realistic on what might lie ahead. He says we're within spitting distance of 4,200. That was our target on the S&P. Now we're shifting direction. Expect a 10% correction in the next 3 to 6 months, a front-end inversion, a 7% year-to-date run, and a banking crisis that will likely take an economic toll triggered our reversal.
It's an interesting comment on the banking crisis. Well, he's not necessarily wrong. It's a very fair opinion. And again, we are up 7%. So it wouldn't surprise me if we had some bit of a correction. Something about the banking crisis, I will say, in 2008, that was an asset crisis. That was a loan crisis. This is a liability crisis. It's the other side of the balance sheet in terms of what's occurred with maturities, rates, and what they were invested in. What the Treasury's done, Scott, is they've come out and they have basically said there's a Treasury put. Everyone's used to talking about the Fed put, but we got the Treasury put. And the Fed put will come if they have to. And I do think what's going on with credit absolutely will slow the economy. People toss around, is it 100 basis points that has been factored into that slowing? No one quite knows. But there's no question that credit is going to slow, and that's further going to contract the economy. That being said, I do not think that investors should be moving away from stocks because the dislocations have already occurred for many of these companies because of what's going on in the credit market.